Okay, good morning, everybody. So as usual, we are meeting today to have another session on Accounting Advanced Level 2025. This is going to be the fourth lecture that we are meeting. And up to date, we have covered few areas of accounting, especially the definitions and the background of this subject we studied properly with the historical evolution. And then we came to accounting entities and also accounts branch. The information level already covered with stakeholders, interested parties, direct, indirect, and all, and advantages to them. And we identified, recognize this subject. Accounting is a process comprised of so many activities, and we named them as accounting functions. So we in detail discuss about the inputs and then process and the output. And we got to know the foundation also. Because I clearly emphasize to this subject, comments or have born somewhere in 14th century and up to date, there's a very good process, strong process, or which is known as, according to this accounting evolution. And we are in a very strong position today as far as the subject is concerned. So all that is because of having what? Very strong foundation. So remember, please. Unless there is a very strong foundation, I don't think that even I can't teach you this subject, even you can't follow this subject. And there is an accounting paper at the examination prepared on the same basis with a one marking scheme. That is also because of this strong foundation, right? So what we looked at in this foundation was, we have Sri Lanka accounting standards comprised of LKSs and SLFRSs. And also we have accounting concepts, especially known as generally accepted accounting principles. Everywhere in the world, if accounting function is taken place or account activities are carried out, or in other words, finance statements are prepared and presented, so same basis is followed, or same generally accepted accounting principles are followed. So because of that, lot of qualities or characteristics can be protected in relation to what? Accounting information, as we have discussed. Especially, let me take one example this morning, that is faithful representation, or in other words, comparison. So comparison, comparability is possible when accounting is, or in other words, simply finance statements are prepared on same basis, applying same generally accepted accounting principles, and so on and so on. So that is not a simple thing to identify and simple thing to follow also. So therefore, that is one of the best reason to have this kind of a evolution up to date. And also, secondly, we discuss, or thirdly, we discuss double entry system and the accounting equation. I have noted in the picture that I have given you, figure. So I think you all took down that one in your books of records, and they are accounting equation and double entry system introduced by Luca Fazioli, being father of accounting in the latter part of 14th century. So the double entry system I did not so far touch, but I wanted to first emphasize accounting equation to you and then move into double entry system. So it is my duty to explain the last part of the foundation also. Last part I have included laws, rules, and regulations. Especially we have Companies Act number 7/2007. When I teach you company accounting, I will be taking Companies Act requirements into there. And also when I teach you this subject known as the lesson known as partnerships, they will be looking at Partnership Ordinance of 1890. So those rules and regulations we are using, we are applying in preparation of financial statements for incorporated companies as well as partnerships, right? So those things you will experience in future, not today, right? So what I have given in that process is something that we should know what we are going to do during whole your accounting program in relation to financial accounting. So like 1.5 years of time, or let's meet very close 2 years, we are using that process. They are one by one taken and detailed discussions are carried out. So that's what the accounting process that I gave you. And other side, we got to know the accounting output as well. Every day I'm repeating components of a set of finance statements. Basically, we have statement of financial position, statement of comprehensive income, statement of changes in equity, statement of cash flows, and also notes to the financial statements. So those are known as what accounting output, right? So that is the process that we are supposed to learn and I am supposed to teach, right? So I'll be doing that. And then my responsibility, I told you, to take you to the track and then giving you all these whatever knowledge stuff in a rational basis, or like enable you to capture easily, efficiently, effectively. So that's what our objective or my objective of teaching this. So that's why I got to know even better to discuss what accounting elements or elements of accounting first. And last week I tried my level best to emphasize you or make distinguish between what are going to be elements and also characteristics, right? Because those two words are always in the paper. So if you don't understand what is meant by an element and what is meant by a characteristic, so going to be finished. Disaster, right? So elements, I told you very clearly, that is going to be something very general and which is going to be compulsory in nature. Whereas characteristics can be varied from one to one person, so it's different concept, right? I got example, partnerships, right? Taking a definition for partnerships, I explained you how to identify the elements and how to identify the characteristics. I'm not going to again and again discuss that matter. So if you see your notes, clearly you can see it. And then having said that, what that I wanted to look at, then under elements we have 5. So basically assets, liabilities, expenditure, income and equity. So those are going to be 5 elements in accounting. And last week latter part, I start off explaining you assets. What is meant by assets? So if you can pay attention to the board, I think I gave you the topic or subtopic known as assets. And I tried my level best to explain you with a small clarification, right? Assets. You can pay attention, right? So when you take assets, simply we known as in simple A, capital A, simply known as A, right? So coming to assets, I told you assets are going to be nothing but economic resources of an accounting entity, right? Existed as a result of past transaction and having controlling power, controlling ability, and also expect to inflow or receive what? Benefits, enduring benefits from that resources. So if those conditions are satisfied, we can say that is an asset, right? That asset is an economic resource existed or created as a result of past transaction, right? And we have a controlling power over there. We can control that asset. And also, we expect to receive benefits in future. So if that condition or of all these conditions satisfied, we can, that is an asset. Right? Examples I gave you: land, buildings, machineries, motor vehicles, furniture and fittings, equipment, stocks, debtors, even goodwill, cash and bank, prepayments and all. So the whole stuff that could be tested in your examination have been given to you. The whole stuff I have given to you, right? So therefore nothing I have missed, I believe, according to my memory. And then assets, when you take, I told you I have given an order. So when I was giving last week the whole list, I tried my level best to protect that order that is known as what? Liquidity order. What is liquidity was explained to you. Liquidity is nothing but an ability of converting any asset into cash, right? So some assets are there, very quickly you can convert into cash. And if you take cash and bank, actually, that is a perfect liquid asset. Cash is cash. Cash and bank is, nothing to convert. Okay, demand deposit balance, which is there in the current commercial bank, and also cash, which is with you, is going to be perfect liquid asset, nothing to convert. Cash balance itself is cash, right? Nothing to convert. So therefore, known as what? Perfect liquidity we have. Anyhow, if you take stocks and debtors even comparatively, within very short period of time, you can convert into cash. But if you take non-current somewhere, I mean land, buildings, and motor vehicles, machineries, furniture, and all that, when you try to convert into cash, it takes time. But you can convert into cash very quickly with capital losses. When I say I'm going to sell my car at 100,000 rupees, even you can, I think you will give me offers. Okay, I will come and buy it. Don't give it to anybody else. Wait 2-3 hours. I'll come and see and buy it. So that means now with a huge capital loss, I can make anything into cash. That does not mean what? Liquidity. Liquidity is a different concept. So we try to convert anyway into cash with market value or fair value. Fair value accounting is very much highly appreciated, recognized today's world, right? Fair value accounting. So when you take fair value, if you are going to sell it to fair value, I don't think such easy to make that one into cash. It takes maybe months and months, years and years, maybe sometimes, right? So that's why those are known as what? Low liquid assets, which is known as non-current assets. So basically, current assets, high liquid assets. Non-current assets, we can say low liquid assets. And also, the other thing is, there are some assets, there's no liquidity at all. When it comes to incorporated companies, you see, okay, there's a debit balance in the retained earnings. Could be when continuously making losses by the company. Okay, retained earnings can be a negative balance. Okay, debit balance. There's no any profit side of that, right? Always there's a debit balance, which is recognized as an asset because debit balance, no, right? But remember, there is no any possibility to convert into cash. So even another one we can say preliminary expenses of an incorporated company. To form a company, primarily we have to expend some money, which is known as preliminary expenses, right? So once expenditure incurred, that is a debit balance, right? Which is recognized as an asset. So long period such balances are there in financial statements, brought forward from each year to other year, every year continuously, but no point of converting into cash is impossible. Those are debit balances, which is known as, we can say, forged debit balances in books of accounts. And those balances better to write off, no point of keeping them all, right? But anyway, until written off is taken place, we have to show it as an asset, debit balance, which is recognized or named as what? Known as what? Fictitious assets. FICTITIOUS assets. Fictitious means what? No liquidity at all. Zero liquidity. So that way, liquidity side, I have tried my level best to organize the list of assets that I given it, right? And when it comes to assets classification, even one thing now I explained to you now, but coming to assets, this classification, I think I told you, okay, I can classify based on physical existence. Based on physical existence, I can classify the asset, right? Physical existence. Remember the wording. Based on physical existence. And also other side, we can say based on liquidity. Based on liquidity. Okay. So physical existence and liquidity. So there are two criteria that we can use to classify the assets. So coming to physical existence, asset is not physically existent. Sorry. Here asset must be physically existent. Now, Now, maybe sometimes if you look at the physical existence, some assets are there, physically existed, you can see the asset, you can touch the asset. Those assets are known as what? Tangible assets. So therefore, let me divide this based on physical existence area into two places. Number one is we can say tangible assets. Tangible assets. The other one we can say intangible assets. Intangible assets. Right? So tangible assets are intangible assets. What is meant by tangible? As I told you, physically existent. You can touch the asset. You can see the asset. There is an existent material, you can see it. But coming to intangibles, actually the opposite of that. You can't see the asset, you can't touch it. Not physically existent, you got the point. So here, tangible assets you see, examples I can give you: land, buildings, furniture and fittings, right? Even we can take stocks. All these things are tangible, even cash, tangible. Intangible, you can't see and touch. Okay, that means physical not available, right? No physical existence at all. Examples I can take here, very good example is goodwill. What do you mean by goodwill? I explained last week, I'm just refreshing what you did, right? It's my nature of teaching. I just want to refresh what we did last week. So coming to this goodwill, you know, that is something good faith, won from the customers. When I want good faith from my customers, do you think that we can see it, we can touch it? No, we can't see, we can't touch, right? We can't see, we can't touch. Okay, goodwill. Goodwill is good faith. Good faith nobody can touch. Or in other words, another definition I can say, an ability of attracting all customers again into the business. Old customers. My all customers are attracted into the same business, into my business, which is known as what? Goodwill. Because of goodwill, we can attract. Okay, otherwise getting attraction is not easy. If there's no goodwill, not easy to attract customers again into the business. You got the point. So therefore, what I say is, goodwill is an intangible asset, very good asset, but you can't see, you can't touch. But according to my understanding, what I can say is, intangible assets are more important than what? Tangible assets. You got the point. Why do I say so? However much facilities or other assets have been provided to a business entity, an accounting entity, okay, you can't be in the business, you can't be in the market. Your market survival is not protected if you don't have what? Intangibles, if you don't have goodwill. Now, I can't speak to you like this, I can't conduct this lecture if there's no goodwill to me. Okay, as long as we have goodwill, we have students to teach you all. Got the point? Otherwise, no customers means we'll have to close down the business and say goodbye. Right? So it's not easy. It's not easy for us to have the goodwill. Clear? In some boutiques, you can see there's no customers. Right? Morning, the owner comes and open. Evening, leaving, say tata bye. Even impossible to cover up the day-to-day expenses as well. Running expenses even impossible to cover up. So better to shut down, close down, no point. But in somebody you can see a lot of customers, even so difficult to manage even, right? So that much of customers are coming, so a lot of helpers are there to help and all. Even you see some shopping complex and all, right? So anyway, adequate controls, everything has been introduced there because, okay, customer base is very large. Large customer base is there. So therefore, that means, okay, they have very good goodwill. Very good goodwill we can see in such organizations, right? So that's why people are coming. So if customers are coming, there are sales. If they are coming, no sales, no revenue at all, right? So as they are coming, they have. So with that sales, what is happening? Okay, then they can earn profits. So their business survival is protected when they earn profits. Clear? So that's why I'm telling these intangible assets are very important rather than what? Tangible assets, right? That's the thing that we want to learn. So goodwill especially I talk because very familiar asset for us, intangible. Even under partnership is going to be a separate lesson for me to teach you, even for you to learn. Clear? no past papers without goodwill adjustments in the history of accounting. So therefore, you need to properly learn this. So I will very simply take in all these aspects into your account in future. Don't worry too much, right? Okay, I'll be taking. Now I'm not going to write examples here. Last time I gave you, right? So coming to other side, this based on liquidity you see here, we have three kinds of assets. Even I explained it this morning also. High liquid assets, low liquid assets, and non-liquid assets. Okay, high, low, no liquidity, right? I'm going to further explain this liquidity and all. High liquid assets are also what? Current assets, right? High liquid assets are known as what? Current assets, right? Low liquid assets are known as what? Non-current assets. Non-current asset. That is known as what? Low liquid asset. Liquid is very low comparatively. So we can say non-current assets. Here, no liquidity means what? Fixed FIC, TIOUS. Assets either it is. You can say 50 ECS assets, right? Those are just debit balances, but nothing is impossible to convert into cash. Right. So these are the three types of assets that you need to identify, because in the statement of financial position, we don't have separation like tangibles and intangibles. We don't have. What is there in the statement of financial position, one of your set of finance statements, one component, right? They are non-current assets and current assets. Even fictitious, we don't write. But if there is, we know that is what fictitious asset, right? You go to know. Reader knows, everybody knows, right? So therefore, current assets and non-current asset classification is very much important in the statement of financial position. So current assets examples I gave you, cash, debtors, and all. Non-current land and building, furniture, all that can be taken, right? So classification about the asset we have completed last week. Now coming to asset, remember, right? Assets. You can think about the double entry system which was given by Luca Pacioli. Now I'm going towards double entry and the accounting equation. Then easy for us, right? Now coming to double entry for assets, right? He said, increasing an asset always, no, you can write down usual balance. Usual balance of an asset account is debit. To increase the asset, you want debit. To decrease that, you want to credit. So, okay, got the point. So that one you might have learned even by now, and even you would have seen, you would have heard and all earlier. But anyway, I will give it to you, right? So before that, you can have a small note on this, right? Small note on this. So last week, in a better way, you have completed this one, entire thing. Now, shall we have small subtopic? You can say, tangible assets. Quickly, please. You can say tangible assets. Write down. Tangible assets, your subtopic. Another you can say. This refers to the asset that can be seen and can be touched as they are physically existed. As they are physically existed. As they are physically existed. Right. As they are physically existed. You know these things, right? Now examples write down, can say land, motor vehicle, stocks. Enough. Because that day the whole stuff we have written down, so now just for understanding purpose, we wrote down 3 examples only. Then we can move on to another subtopic. We can say intangible assets. Tangible assets we got to know. Now intangible assets. There you can say this refers to the asset that cannot be seen, and also cannot be touched, as they are not physically existed, right? Full stop. Example, take down goodwill. That is going to be the most familiar intangible asset, goodwill. Right, so that side we can finish. We have another, can say, subtopic liquidity. It's my responsibility is to explain about that subtopic. You can say liquidity, LIQ, UIDIT, liquidity. Correct spelling you need to follow, right? So under that you can say, this refers to an ability. This refers to an ability of converting any asset into cash. Without making capital losses. Right. That is the real meaning of liquidity. Now, have another subtopic, we can say non-current assets. So under non-current asset, you can write like, you can say, this refers to the asset my topic was non-current assets. You can say this refers to the assets which has low liquidity compared to other assets. Low liquidity compared to other assets. Full stop. So example, you can say land, buildings, furniture. That's it. Compared to other assets, it has low liquidity. Then we can say another subtopic, current assets. There you can say current asset, there you can say this refers to the asset which comparatively has a high liquidity. Comparatively has a high liquidity. Full stop and say one example, you can say debtors, stocks, and one more we can say cash and bank. Those are examples. Ideal examples for This what? Current assets. Right. Then we can have others after. We can say fictitious asset. FICTATIOUS, ASSECTS. Fictitious assets. FICTATIOUS assets. And that you can say this refers to a category of assets. This refers to a category of asset. This refers to a category of asset that does not have any ability of converting into cash. That does not have any ability of converting into cash. No ability at all. Here you can say example, preliminary expenses. Preliminary expenses. You can say preliminary expenses. PRELIMINERY. Preliminary expenses of a limited liability company. Preliminary expenses of a limited liability company. The other one you can say right. First one you got to know. The other one you can say debit balance of retained earnings in a limited liability company. Debit balance in retained earnings. Debit balance in retained earnings of a limited liability company. Example we can say, or even we have given now. Okay, examples we'll see when we work out sums, right, for companies. That's okay. So I explain you what is meant by fictitious assets and gave you 2 examples. Okay, right. Don't say examples, they are not necessary. We'll explain it later, right? When I discuss company accounting. All right. Okay, now assets, we got to know what is meant by an asset and also the classification very clearly got to know. Now, what is required is what Luca Cassioli said about assets, right? He told us to think in this way, easy. Usual balance of an asset account is debit. Simply DR. He asks us to think that usual balance is debit. I am reading to all the whole community of students. So might be those who have not done O-level commerce. Even my case, if you look at, I was not done any O-level commerce, right? O-level examination. But start this advanced also in commerce stream. There may be still like this here also, right? Anyway, we can say usual balance of an asset account is debit. Then to increase, if you want to increase, you want to do the same thing, debit. DR. You want to increase, let's say we have 50,000 worth of assets, cash. Cash you want to increase up to 75,000, 25,000 you can debit. So I will come via debit, via credit. So for that remember, usual balance of an asset account is debit. To increase that you want debit, do the same. If you want to decrease, it, you want other side, you can say credit. Right, to decrease you have to credit. You got the point. So debit and credit. So still you don't know, but when it comes to ledger and all ledger accounts, you will get all. Now here usual balance of asset accounts is debit. To increase you want to do the same thing, debit. To decrease you want to do the credit. That's it. That's all about assets, which usually taught by lookup SQL in relation to double entry system. Even today, that is used very effectively. Even for my teaching also you can see very much helpful this double entry system. Right? You will also in future experience and will be the very best. Okay. Right. In future you will see how this double entry system is important and even imports of that double entry system. Right. All right. So with that, let me stop this discussion on assets. I don't want to discuss more and more by now. I just want to emphasize very few areas of assets. Then shall we look at then second element, which is known as liabilities. Right, liabilities. So what is meant by liability? According to case 1, presentation of finance statements very clearly given there. Liability is also existed as a past transaction. And the thing is, there will be an outflow of resources in settling it in future. When you have a liability exists as a past transaction, we are settling no. In settling, there will be an outflow of resources. Right? That is what given under liabilities. So liabilities are recognized as what? Current obligations, present obligation. What is obligation? Obligation is which is payable, which is settlable. That's only advance obligation. So therefore liabilities are nothing but what? Something existed as a result of past transaction and which is expected to have an outflow of resources, which is expected to have an outflow of resources in settling. Right. So I can say basically liabilities are present obligations, right? Created or existed as a result of past transaction, and also there will be an outflow of resources in settling. So remember now here what is important is those words when you are defining past transaction, present obligations, outflow of resources in settling, and those things are very much important. Shall we say there? Can say liabilities are nothing but present obligations. Liabilities are nothing but present obligations. Present obligations. Existed as a result of past transaction. Existed as a result of past transaction. Existed as a result of past transaction. Which there will be an outflow of resources in settling such liabilities. There will be an outflow of resources in settling such liabilities. That is the meaning or real understanding about liabilities. That's what you want to remember, right? Examples, please. Number one, you can say bank loans. Number two, we can say debentures. DEBENTURES. Number three, you can say preference shares. Even nowadays taken as liabilities. Preference shares. PREFERENCE. Shares. Preference shares. And also you can take lease creditors. Lease creditors. I'm happy to give it to you. Bank loans I took, no. Then we can say creditors. Then we can say accrued expenses. Accrued means payable. Payable. Accrued expenses. Accrued expenses. And also we can say bank overdraft. Bank overdraft. Bank overdraft. Okay, enough. I have given an order from that list also. Start with somewhere, bank loans, and then lease creditors, before that debentures, preference shares we got. Then we have creditors and so on and so on. So that has been also arranged in an order. You need to apply the same order at the examination also. Clear? So that was about liabilities. Simply I defined it and list given. Right. Now, when it comes to liabilities, how to classify these? Remember, look at the board. Liabilities are going to be two types like this. Don't write and give the time for you to take down. You can say liabilities, we can say here, based on ownership. Based on ownership. Now, based on ownership, we can categorize liabilities. Clear? Based on ownership. Who is going to be the owner of that liability? And the other side, we can say based on time taken to settle. Right? Based on time taken to settle. When you have obligations, current obligations or liabilities, we have settled them now. So therefore here we can say based on time taken to settle. Here we can say based on ownership. There are two bases that we can use to classify liabilities. Coming to based on ownership, you see, we have internal and external. We can say internal liability. Here we can say external. Right. We have internal liability, we have what? External liabilities, right? So what is internal liability here, which is known as capital? Known as capital. In other words, equity. I told you there are 5 elements: assets, liabilities, expenditure, income, and equity. Equity is in a way what? Internal liability. So let me take my red pen and write down here equity. Internal liability but equity. Right? Okay. So that differ from organization to organization. Now, when you take internal liability of a company limited, there we can say stated capital. Stated capital. When it comes to a sole trader business, the sole owner, the value of resources invested by the sole owner. When it's going to be a partnership, we can say value of resources invested by the partners. When it comes to a corporate, company limited liability, I show you stated capital. Even last time when it comes to a society, no profit making motive. In other words, not for profit organizations in that lesson. That is taken as also what? Accumulated fund. So we have sole trader, we have partnership, we have limited liability company incorporated, and also we have not-for-profit organizations. There we can say accumulated fund. So internal liability, which is known as equity or capital, is there, but we take different names under different organizations. That's what the thing. I will give you take down, don't worry. I'll put an asterisk and keep there. I will take it more and more. What is external? External opposite to that one, no? Okay, we have external parties provided loans, provided debentures and supply. money and even maybe preference shareholders. Nowadays taken as what? External liability. I mean, we are taking under debt capital now, not on the equity, preference shares. Those days, you got very old papers, you are misled. Don't read them. So therefore, internal liability is nothing but equity of capital and which is going to be differ from organization to organization. I was explaining, but I will give you a breakdown. Don't worry under that when it comes to that detailed discussion. Under external liability, we are external parties and they are, always we have to pay to the outside party. There will be an outflow of resources from business to outside party. So there we can say, right? Example we can take long-term bank loans, right? So therefore here, in this interliability area, I finish here actually everything easy, I believe. So here if you take like this small table here, to provide you the examples, we can say nature of business. Here we can say interliability. Right? Here, name of the business organization, here interliability. Right? Number we can say sole proprietorship. Sole proprietorship, I have only few letters. First one, sole proprietorship, we can say, and here we can say, in the liability side, we can say, value of resources introduced by the sole person. Value of resources introduced by the sole person, single person. Now we can move on to second one. Second one, partnerships. Second one, part, you can write, you can't read my letters, but anyway, with P, partnerships. You are listening to me, partnerships. In the library, you can say, value of resources introduced by the partners. Value of resources introduced by the partners. Value of resources introduced by the partners. Now, third one. We can say incorporated, INCORPORATED, incorporated companies, or which is known as limited liability companies. Anything you can use, right? But real word is incorporation. So we can say incorporated companies. What is in liability? Is stated capital. You can say stated capital. In singular we call, stated capital here, prakasta pragdane. In singular. In English we say what? Prakasta pragdane. In case of what? Incorporated companies. Now in case of last one, write down fourth one. Not-for-profit organizations. Not-for-profit organizations. There you can say what? Accumulated fund. I think you are listening and remembering. Later you can say not-for-profit organization, you can say accumulated fund. Don't worry about this, but this will be discussed later in detail. Accumulated fund is going to be the internal liability. Right. Now, external means outside parties. Example, you can say bank loans, debentures. Right. External bank loans and debentures. So, further you can say, but these two are important. Even you can say creditors. Creditors, they are coming as one. Credit purchases. When you make credit purchases, you are creditors. We'll take it up later in detail when it comes to generalization. Now, based on time taken means when there's liability, there should be a time requirement to settle the liability. Today you take a bank loan, tomorrow you're not going to offset it. It takes time. You got the point. In case of settling. So therefore, based on time taken, let me divide this one into two. First one you can say non-current liability. The other one, what? Current liability. Okay. Non-current liability, current liability. What is non-current liability? You know, comparatively, it takes more than 1 year of time to settle that liability, which is known as non-current liability. Current liability means comparatively, let me say less than 1 years of time. Within 12 months period of time, you are supposed to settle. Within 12 months of period, you have to settle it. So that's what the meaning of what here. Based on time, here we can say current liability. So current asset, current liability, non-current liability, both things, you need to have that order that I have given. In the very first list, I have followed that list. Order, please. Now here, non-current liability, you can write down 1 or 2 examples. We can say bank loan. Then we can say lease creditors, which you are going to study in detail. Current liability, we can say creditors, comparatively less than 12 months. Creditors, we can say they accrued. Right, accrued expenses. Creditors and accrued expenses, we can say bank or draft also can be taken. Bank OD means bank or draft, you know, all those things. So those are few examples of what? Current liability. So non-current liability, current liability, we have what? 2 types of liabilities there. Now, when it comes to these liabilities, there's another special category of liability which is recognized as contingent liabilities. Contingent liabilities. So, usually when I teach to my students, let me put a mark, here arrow somewhere below, you can say contingent TIL. Contingent liabilities. Right. I have written in what? Red color, right? CON, not bracket here. Contingent liability. Why I have taken this one here? Contingent liabilities are connected to liabilities. Classification based on time. Contingent liability also, it goes to the time factor. So therefore, when I teach my student this subject, actually I take what? Non-current, current, and also this contingent liabilities also I am taking here because all liabilities based on time. Contingent liabilities are connected to time. I will tell you later. So therefore, contingent liability has a separate standard also. Why that is that much important for your subject of accounting. So today I just explain you what is similar contingent liability and so on and so on. But when it comes to that standard, I'll be teaching you what contingent liability standard there. Okay. For the time being, these examples and this water percentage is more than enough. Can you please take down? Give me 2-3 minutes. You can proceed. Write down, please. Then later I will be taking one by one and explain to you. Don't worry. It's my responsibility, right? Write down quickly. I want to drink some water and come. Quickly, please. I think completed, no? You took down everything properly. Right. If you don't get my letters, internal liability, external liability, here known as equity as well. I explained you the reason. So equity differs from organization to organization. It's a sole trader business. Here value of resources invested by the sole person, single person. Here partnership, value of resources introduced by the partners. Incorporated company, here stated capital. Here I take not-for-profit organization, the category of organization. Here we can say accumulated fund. So I have given you those things now explained clearly. Okay. Coming to external liabilities, bank loans, debentures and creditors we can take for the time being. And coming to based on time taken, I have taken non-current liabilities and current liabilities. Examples, bank loans and lease creditors. Here, creditors, accrued expenditure, and bank overdraft, bank audit. I think examples you took down if any mistakes are there. You missed something. And at the same time, I told you, we have another category of liability known as contingent liabilities. I have taken it here as contingent liabilities, right? So why I have taken that there as separate one? Because contingent liability is always connected to the time factor. So as that is connected to time factor, I have taken that topic also there. Clear? Right. Okay. Now, what we can do is we can take one by one and explain. Right. So here we have a summary. Right. So like a short note. Right. So we can have a summary. So here and we can write down one by one. Can have subtopic. We can say internal liability. Internal liability. And that's you can say first type of liability, right? You can say this refers to present obligations towards its owners. That's it. This refers to present obligations towards its owners. Right? Present obligations towards its owners. Right? That's it. Okay, I have given the table here examples enough. But there one more sentence I would like to add. Okay, I did not explain you so far, but it's there. This internal liability we recognize in the books of accounts as a sort of what? Concept known as what? Business entity concept. Under business entity concept, what we do is business and the owners we identify as separate parties, two separate parties. Business is a one party and the owner is another party. Owner is another party. So therefore, better to say here, we can say internal liability is recognized. Internal liability is recognized as a result of business entity concept. As a result of business entity concept. Internal liability is recognized in the books of accounts as a result of internal liability. Sorry, as a result of business entity concept. Which business entity concept, which the business and the owner, which the business and the owner are recognized as two separate parties. Are recognized as two separate parties. Are recognized as two separate parties. Two separate parties. Right, so that idea you want to remember, why this internal liability is recognized in the books of accounts. Okay, other one you can say, subtopic, simply you can say external liabilities. External liabilities, external liabilities. External liabilities, there you can say, this refers to present obligations. This refers to present obligations. This refers to present obligations towards the external parties. Towards the external parties. Towards the external parties of an accounting entity. Of an accounting entity. External parties of an accounting entity. The examples here given, I don't want to repeat it again, right? Then we can say another subtopic, non-current liabilities. Shall say non-current liabilities, another subtopic. Non-current liabilities. Non-current liabilities. There you can write. This refers to present obligations which usually take more than 1 year of time. Usually take more than 1 year of time. More than 1 year of time to settle. Full stop. Okay, what is important now? It takes more than 1 year of time usually. Okay, to settle. You can keep the full stop there. Right? Full stop there. Then examples I don't want to repeat given here, right? So we can say other one. Current liabilities, we can say. This refers to present obligations. Better to always say present obligations. There must be an obligation created now, existed. This refers to present obligations. Okay. Small technical issue. Now this refers to present obligations always. You have to have that one always, right? So we can say under current liabilities, I can say this refers to present obligations. Comparatively, takes less than 1 year time period, less than 1 year time period to settle such obligations or to settle such liabilities. Less than 1 year to settle such liabilities. Right, comparatively, right? When you compare it with what? Non-current. So you can have here examples. I have given creditors. Here given no in the summary. Creditors, bank overdraft, accrued expenditure, so on and so on. Now understand the way of explaining that. Don't worry, these areas are again discussed under LKS 1, percentage of finance statements. When I do the standard, very close by your examination, then in that note, you will see how those things have been defined by the Institute of Chartered Accountants of Sri Lanka. Those are there as it is in the marking scheme. So that's why by that time I will give you a small printed handout, all prepared based on their wording, technical jargon and all. Otherwise, you won't get marks. That's all. And I was telling you, you have to use a red color pen and say another sub area, contingent liability area. So in your book, you can say another subtopic, contingent liabilities. What? Contingent liability. You can write up, please. Contingent liability. You can say there. All right. Before that, let me explain. I think I did not. Right. So let me erase this board and come to that topic separately, because that is very, very important. Very much important. Right. Now, this is also a little bit boring type of a thing I am teaching, because next year onwards, I will be providing you tools which has sums. So we are going to work out sums since next week, most probably. Once this theory area is over, then we can work out more sums, which is going to be very, very interesting. So what I'm going to talk about is contingent. Contingent liabilities. LIABI-LITIS. Okay. What is contingent here? What does it mean? Contingent liability means we don't have a liability, present obligation by now. Because to be a liability, I told you there should be a what? Present obligation, no? Created as a result of past transaction. But here that is not there. But I am placing it under what liabilities I told you. Because so connected to time factor. Now what is contingent liability? You remember, at present there is no obligation, but expected to happen in future. So that kind of liability is not what contingent liability. So contingent liability refers to an obligation or liability which has not occurred at present, but expected to be happen in future. But expected to be happen in future. Okay. Then maybe a question comes to your mindset, why then we are bothering about too much on this? Let that to happen now. Once happen, then we'll take it into serious or we'll take it into accounts. Why we are bothering so much in advance now? Right. So I will take you example and I will explain why and how. Let's say what are going to be example. One example, very ideal example for this, even given by the Institute of Account and also in practice. What is going to be, a case filed against a company and which is being heard in present, in a court, asking a compensation of rupees, let me say 50 million. One person in a company has filed a case against this company asking 50 million compensation. Maybe due to one reason, I don't know. One of the reasons. Maybe he has been, done some, injustice or something. We don't know actually. Anyhow, whatever the reason, we don't know, but one of the employees of a company has filed a case against this company asking a compensation of 50 million rupees. That's what the basic example. And also I told you that case is been heard at present in the court. Merely because people file cases, if those things are not heard or heard by the court system, then no point. They don't worry, please. Don't worry, let them to file. We don't worry about it. But problem is, already filed, amount is already given there, 50 million, and also which is being heard in the court system at first. If it is so, then we have to consider it, right? As a what? Contingent liability. Then asking, what is the role of accountant? What is the role of accountant over there? That's the other question. Role of accountant. What accountant is going to be there? And what is it? It was tested in one of the past papers, right? So accountant needs to look at, okay, whether this contingent liability will happen or will not happen. Or what is the probability of happening or what is the probability of not happening? How the accountant is going to ask understand it with the lawyer. Because when there's a court case which is being heard, can you go to the court and talk to the judge? We can't. If I try to go there and talk to the judge, definitely will be taken to custody, will be taken to jail or somewhere. I will have to go inside the box. So therefore, we are not allowed to be human beings, go inside and talk to judges, right? So when there are court cases, legal cases, we have a lawyer hired. So accountant's responsibility is to hire the lawyer or talk to the lawyer and see whether this will happen or this will not happen, right? So that can be tested with the lawyer because he is an expert in the subject. Accountant is not an expert in law. Accountant is an expert in accounting, that profession. But lawyers are experts in law. So therefore, lawyer may say, okay, accountant, I think we are going to win this, no problem. Company point of view, we should not pay any a single rupee compensation. This is going to be, injustice or injustice case they have filed. Actually, grounds are no sound grounds are there, no enough adequate evidences are there, no strong evidences are there. So we will win. Who says? Company lawyer says to whom? To the accountant. The accountant says, no, even you are telling in verbal, no. You write in a sheet of paper and give it to me. So paper evidences are to be collected from the lawyer. By whom? By the accountant. Then the accountant gets that certificate or whatever the document from the lawyer and we disclose it in the finance statements. The accountant is supposed to disclose it. Don't hide it. Why? That is material actually. Why what is that material? Because that information when you put into finance statements as a note, so much of asking compensation, so and so file a case and be near like that. The future investors, their decision may be change. Okay, oppose this company, your employees also file cases, maybe not this company is treating to the employees. If they are not treating employees, then what about the shareholders? So likewise, some sort of an impression can be taken by such statements by the intended investors of that company. So therefore, they don't compel to buy shares. So because now that information when you hide, nobody knows. But when you disclose in the finance statements, okay, that will have an impact on the decision-making process of intended investors. So that's why we are asked to disclose it as a note. But if lawyer says, definitely that will happen, then can we keep quiet? No. Lawyer may say that we don't have adequate evidences. He is very powerful, strong justifications are there. He has filed the cases with good grounds and all. We don't have any say. So we'll have to pay anyhow. According to the situation, it's going to be more towards their side, not our side. If it is so, we have to make provision in advance, year by year, until the decision comes from the judge. By the day that the decision comes from the judge, so we have to get ready with adequate funds in order to settle this 50 million compensation. Otherwise, we will keep quiet and present profit if we enjoy everybody honors. If enjoy, remember what happened. In future, the day that you get the decision, okay, to pay 50 million compensation, you are in a struggle, you are in a trouble because it's shortage of funds. That's why if the probability is very high, we have to make something from the profit for contingent liability. You can say debit the P&L, credit the contingent liability account. So that's how things are going on. The accounting treatment you will learn later. Now theory gathering, so remember the theory. Okay, if that is going to happen, very serious, very serious. We have to be very careful. Clear? And now other thing is remember, if not happening, then disclosure requirement is more than enough. Who says all these assurances? Given by the lawyer, because he's an expert in the subject. Clear? Right. So that's why this contingent liability is very important to you. Definitely test it, right? Okay. And I must tell you, where do you credit that profit? Every year in advance. Debit P&L provision for contingent liability account. What the color going to open? Account is provision for contingent liability account. Okay. Year by year, part of the profit we transfer it to that. The balance part the owners can enjoy. Clear? You will see all this when it comes to accounting area of companies. Clear? Write down there. I can say. Under topic contingent liability, can say this refers to the liabilities which has not been occurred at present, which has not been occurred at present, but expected to be happen in future, right? Example, please, you can say example. A case filed by an employee against a company, asking a compensation of rupees 50 million. Asking a compensation, you can see the board. Asking a compensation of rupees 50 million. Asking a compensation of rupees 50 million. Right, rupees 50 million. Asking a compensation of rupees 50 million. Full stop. Then new sentence you can say. It is the responsibility of the accountant. It is the responsibility of the accountant to assess the possibility of happening this liability from the lawyer or with the help of lawyer. Full stop. With the help of lawyer, full stop. You can continue. If the possibility is very low, comma, disclose in the financial statements disclosed in the financial statement is adequate. Is adequate. Disclosed in the financial statement is adequate. Is adequate. Is adequate. Full stop and continue. If the possibility is very high, probability or possibility, whatever. If the possibility is very high, comma, provision should be made. Provision should be made each year from the profit. From the profit. To the you can open inverted commas to the provision for, open inverted, provision for contingent liability account, right? Provision for contingent liability account. You can keep the full stop. Keep dot full stop. Right. So that is going to be the whole stuff according to this standard, and also, I mean, for trying for advanced level, this is more than enough. You understood what is meant by contingent liability and example discussed, and then account treatment. So accountant needs to check with the lawyer. If lawyer says no, we are winning, no any future liability, so then disclosure is more than enough. But if lawyer says difficult, we are losing, if it is so, we have to make provisions in advance finance statements, into which account provision for contingent liability account is. So that very, very important account in the ledger, provision for contingent liability account, right? Okay, remember please. Very, very important. Right. So with that, liabilities, I have finished it off. The normal theory that I am supposed to teach you, but this topic also will be taken when it comes to where? Case 1, percentage of finance statements, all definitions, everything will be given to you very clearly. So regarding liabilities, what Luca officially said, he said, write down everybody, usual balance is credit. Credit, CRDAT within bracket CR. Then in order to increase, CRES. In order to increase, you have to do the same thing, credit. DAT. Right. Then to increase, so to decrease, that means the other side, no? Increase, decrease, we have debit. Yeah. I am talking about any liability account. If you take usual balance is credit, to increase credit, to decrease debit. That's it. Let's say we have a cash, we have bank loan liability, 100 bank loan. As long as you take more loans, what happens? That account is credited, no? Liability increase in credit. If outstanding balance is 500, if you take another 50 million, or whatever, 500 million, 50 million, this goes up to 550 million because that additional finance bank loan you got is added there. And here, decrease, you want to be the other side now. Okay. The other side of the account, I mean, we have to debit there. That's all about liability area I have done, which is required and which is essential for your all level in this year, grade 12. You all are moving to grade 12 now. Okay, anyone to identify grade 12, right? That's good. Right. So far, any problems? What are the problems that you have so far? I don't think any problem is there. Okay. Still, we are collecting the theory. Got what? Right. So as you have done it, then we can move next area, which is going to be expenditure. I would like to take expenditure first and then move on to what? Income, expenditure. Actually, what do you mean by expenditure? Expenditure is nothing but, expenses that we incur in running a business, that's it. When you are running a business, there are some expenses that you will have to incur. Those things are known as expenditure. They can say, this refers to the expenses incurred. This refers to the expenses incurred. Expenses incurred in operating a business. In operating a business. All right. Now listen to me. Example right now, you can say electricity, wages, purchases, purchasing of machineries, water bill, right, so on and so on, enough. So whatever you purchase and all other expenses in a broader category known as expenditure. Expenditure, I would like to divide into two. What are those two areas of expenditure? You know, you might have studied capital expenditure. If you have done your O-level properly, you must aware with this knowledge. Capital expenditure, you must know. The other side, revenue expenditure. Revenue expenditure. Capital expenditure, revenue expenditure. You know, expenses are divided into two. Capital expenditure means what? Any expenditure that you have incurred means not paid, relevant for the period, that meaning is there. Any expenditure that we have acquired or that we have paid in order to acquire, to install or to develop any non-current assets can be known as what? Capital expenditure. If any asset is built up or acquired or installed or developed, then we can say that's a capital expenditure. So capital expenditure, if I write down something here, you can say to acquire, to install, or to acquire, to develop. Right? If any expenditure incurred in order to acquire or in order to install or develop any non-current assets can be known as what? Capital expenditure. Right? So let me take a small example here and show you. This is what capital expenditure includes, right? Then we can say, example I am writing here, please pay attention. Purchase price of a machine. Let me say 800,000, simple figures. 800,000. All rupee value, right? Then we can say transport and engineering charges. 100,000, you see. To bring the machinery from the seller's place to our place, our factory, we have to pay how much? 800,000 to the vehicle. Clear? Is it clear to you now? Right. And also the purchase price of this is going to be 800,000. I hope you understand. Right. Then example. Then let's say, now with the machinery, the daily output is, let me say, 500 or 400 units. Per day, your production maximum operating level is going to be what? 400 units. But you know, demand is there for like 600 or 750. Per day demand is for that unit 700, whereas your machinery can produce only 400 per day. Then better go for a new one. No, intelligent businessmen, they don't depend on this, right? Whether understand the way that they have done is a different thing. But intelligent businessmen, they don't give up that that over demand. You can supply only 400, they are asking more. Demand is more. Okay, which is known as over demand. So excess demand, other word. Intelligent businessmen, they don't give up this. So what they do is, they talk to a consultant. Consultant told me, okay, to fix a motor, to fix a new motor. New motor is fixed to this one. You understand? Purchase price 800. To bring and for installation purpose, engineer was paid 100,000. And also to meet the excess demand, if you produce more than 400 per day, you are meeting the demand, right? So to meet the excess demand, the consultant told please fix another new motor to this machine. The capacity will be double. So therefore, to fix a new motor, let me say 50,000. So with a 50,000 new motor installation, we did not know, consultant showed us, okay, excess demand can be met because your supply has gone up to now 600 units per day. Earlier 400. Now with the new motor, support new motor, now it can be produce how much? 600 units, which you can meet what? Present demand. I hope you understand. So therefore now, the total cost of the machine is going to be 950,000 rupees, 950,000. Now if somebody is asking from you, what is the cost of the machine now? It is not 800 now, it's going to be 950,000 rupees. You understand? So it's going to be 950,000 rupees, not now 800. We purchase price just 800. Now, then and there we incurred capital expenses. We have done what? We have capitalized them then and there. So therefore, now total cost of the machinery is going to be how much, please? 950,000 rupees. Those are tested in your past papers, right? All tested and tested in your papers, term test or whatever. So all tested in your past papers, clear. So therefore, remember the real idea, meaning behind this capital expenditure. So I have explained for what purpose things are done, incurred, and practical, hypothetical example I have brought to your attention. So many different types of things will be taken up later in future in further discussions, but further I'm being now. Common revenue expenditure, how do I say something? Revenue expenditure, I explain the whole thing and I will give you a breakdown later. Revenue expenditure refers to expenditure which service of that expenditure is fulfilled or rendered or limited to that period, the period which expenditure has been made. There's a period of an expenditure. So the service of that expenditure limited to that period, that's it. But when you take a motor vehicle, machinery, years and years and years and years we are using for operating activities. But whereas, when you pay something to telephone, it is like a telecom, or even for these lights and all to CEB. Last year we paid money for last year electricity bill, last month electricity bill, because that was the expenditure for last month, and for last month they have provided service now. That expenditure what you are paid is for that period telephone bill. With that bill, merely because you have paid last year telephone bill, you can't say, no, I have paid last year, free of charge. No, you can't. So therefore remember, if the service of any expenditure is limited to the period which that has been incurred, definitely taken under the category of what? Revenue expenditure. That's the beauty of this thing. Service you can say, right now, can say. No, nothing to say, I will give you later, but let me say like this. This revenue expenditure can be categorized into 4 areas with the requirement of what? Statement of comprehensive income, statement of income. Because there we need to find out or recognize profit for the year, no? Profit or loss for the year. In arriving at profit for the year with the use of statement of income, revenue expenditure we have identified under 4 areas. Number 1 is distribution expenses. Number 2, administration. Expenses. Now, financial expenses. Here are the expenses. I have given you 4 as I told you. Distribution expenses, administration expenses, financial expenses, and other expenses. But now revenue expenses for the purpose of statement of income or statement of comprehensive income. There's no any other purpose. Clear? Right? So distribution expenditure, you can say advertising expenses. Administration salaries or water bill, telephone. Finance cost may bank loan interest we are paying. Interest charges. Other expenses, we can say they are donations, stock losses, such things. Donations, stock losses, something. You can take under what other expenses. I will, or you can take down here. Other expenses, the example here to take down please. Stock donation, stock losses. Enough. So, expenditure categorization I have done on the board. Here we have example, here 5 categories on. These 4 categories are very important for your statement of income. They are, in order to recognize the profit or loss, we are entering in the statement of income these 4 areas. You organize your expense are organized under that. Clear? Okay. Can you take down this sentence? You can say under expenditure. You can say this refers to expenses incurred then and there in running a business organization. I think I gave you that one. You can say this refers to expenses incurred then and there in order to or in doing business activities or in doing business more than whatever it is, right? Right. You can say, also can say expenses can be categorized as follows. Expenses can be categorized as follows. Right. Can you copy this one down to your book, please? Quickly. The handwriting is clear now. I explained and you are listening, and now you can write down quickly. Okay, write down. Okay, take 1 minute, complete quick. Because I can remember one of the exams given 5 scenarios. Asking you to categorize whether it's a capital expenditure or revenue expenditure. So you should aware about how to make distinguish between these two. So that's why I have given everything like a short note here. Please understand. I will dictate what is and all. Don't worry. Take 1 minute and write down. Please quickly complete. I think you completed, right? Good. You can take down subtopic. Capital expenditure, please. You can say capital expenditure. Under that take down, this refers to the expenditure. This refers to the expenditure incurred. This refers to expenditure incurred in order to acquire, install, or to develop. Acquire, install, or to develop any non-current asset. Any non-current assets. Any non-current asset. Any non-current assets. That's all. Example I have given. Now, when a scenario comes from the examiner, you have to do that test. You're asking from yourself that is an acquisition. Is that an acquisition? Is that an installation expenditure? Or is that a development expenditure of that whatever asset? That question one by one you ask. If these conditions are satisfied, then you can say that's a capital expenditure. Otherwise, no. That's all. Example I won't repeat. Now we have written down this one now. I gave you time. Others I can say, please write down revenue expenditure. Revenue expenditure. Under that you can say this refers to the expenditure which. This refers to the expenditure which. The service of that expenditure, the service of that expenditure is limited. That expenditure is limited. To the period. To the period which that expenditure is incurred. To the period which that expenditure is incurred. That was tested in one of the papers. What do you mean by revenue expenditure? So this refers to expenditure incurred, or this refers to expenditure which the service of that expenditure is limited to the period that has been incurred. Given you that expenditure, right? Pulsavanyo, revenue expenditure can be categorized into four, namely, revenue expenditure can be categorized into four, namely, distribution expenses, comma, administration expenses, comma, financial expenses, and other expenses, for the purpose of for the purpose of preparation of statement of income, for the purpose of preparation of statement of income. Okay, so with that, revenue expenditure is over, capital expenditure is over. But I would like to explain you another small concept which is known as deferred revenue expenditure. So revenue expenditure, shall I take red pen and say put here so you can say deferred, D-A-F-F-E-R-E-D, deferred, can write down. Deferred revenue expenditure. Defer, that wording is important. So that is so connected to revenue expense. That's why I have taken here daughters and sons. Under this revenue expenditure, there are deferred revenue expenditure. Right? So what do you mean by defer? Defer means you delay. Now, when you say deferred revenue expenditure, what happened? A certain revenue expenditure has been paid in huge quantities at once. So that expenditure amount can be taken as what? Deferred revenue expenditure. Right? A certain revenue expenditure has been paid at once in huge amounts, okay, is known as deferred revenue expenditure. For future period, for loan future loan period. The best example you can say a huge amount paid to the Rupani Corporation to run an advertising program for 5 years. You are paid 5 million to Rupani Corporation. 5 million, 50 million. At once that huge amount is paid, has been paid for 5 years term. 5 years term. So which is recognized as deferred expenditure. You can't charge the whole amount as an expenditure for the current year. In identifying recognized provider, you're unfair, untrue, unfair. So you are taking a certain portion of that expenditure for the current year. Other amount is deferred. That amount is brought forward. Brought forward to future years. Clear? So that is known as what? Deferred revenue expenditure. Okay. Can write down sub topic there. Can say deferred revenue expenditure and write down. This refers to the payment of, this refers to the payment of a revenue expenditure or revenue expenditure in huge amount at once. To a certain to a certain organization for a loan period. For loan period. For loan period. For a loan period. For a loan period. For a loan period. Example take down. Rupees 50 million has been paid. Rupees 50 million has been paid to the Rupani Corporation for 5 years advertising program. For 5 years advertising program. For 5 years advertising program. Right. For 5 years advertising program. Right. Full stop and say deferred revenue expenditure should be amortized. Amortized means what? Writing off over a period. Should be amortized in future years. Should be amortized over future years. Using a rational basis. 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 So that's what I can say about deferred revenue expenditure. Why I have taken that one here? Because that is one of the revenue expenses we have paid now. A long period at once in huge amounts. So that's why it's the ideal place to discuss about that. That's why I have taken it here. Clear? Okay, good, right. Now, total discussion about expenditure is over with this. And now, what Luca Fessio said about these expenses, that's very important to look at. The expenditure we identified and categories also identified with examples very clearly. And extra this deferred revenue also we discussed. And now what is to be done is what Luca Fessio said about these expenses. We want to learn that. So he said, okay, usual balance as what balance? DR, debit balance. DEBIT, debit balance. Usual balance of an expenditure account is debit, usual balance. In order to increase, we have to do the same thing, debit. DR. To decrease, we have the other way around, other way back, we have to credit. That means in order to increase the balance, you have to debit, do the same thing. In order to decrease, you have to credit, the other way around. So that's what Luca has said about expenses. Remember this theory, double entry principle, very much important in working out sums. I hope you understood that, right? Then we can move to the last one. Last one is what? Income. So last element of accounting is being discussed now. The other day, we can start with what accounting equation. We have to work out sums there. Right. So shall we say income? Luckily, we can finish today. This. Income is nothing but earnings, remember, please. If any business organization has earned something from its business activity is known as what? Income. That income is not just mere getting money into the business. Now, for example, in previous discussion, expenditure also I have the word incurred. Incurred does not mean that cash outflow, money goes out always. No. Incurring means your relevant expenditure you identify in the books of accounts. Money payment, cash payment, different story. Don't mix it up both because we are working on accrual base of accounting. We are always working on accrual base of accounting we are implementing. Now coming to income also same principle. Just mere transferring money from somewhere else into the business. We don't take as income. For example, we sell on credit, we have debtors. When debtor pays money or when we receive money from debtor, we don't take the income. Oh, we have recognized at the point of sale. At the point of receiving cash, you can't take it as income. Finish. Because accrual base of accounting we recognize. So likewise, let's say the owner has introduced some additional capital to the business. Not an income. In previous case, if the owner has taken some money from the business as drawings for personal usage, you can't take it as an expenditure. You can't take. Likewise here, mere transferring money into the business by the owner, which is known as what? Additional capital, you can't consider it as an income. You can't take it. So income always going to be an earning. Can I one sentence? I can say, and this topic can say like quickly, can say this refers to earnings. This refers to earnings. This refers to earnings of a business by doing its business activities. By doing its business activity. This refers to earnings of a business by doing its business activities. Its business activities. Its business activities. Its business activities. There you can say. There you can say. Example, please. Example. We can take sales. Example. Another example can say sales, comma, rental income, comma, investment income, comma, interest income, interest, comma, dividend income. Dividend income. Okay, few examples I brought to your attention for the time being. Then and there we'll take it up everything. So income means some sort of an earning from business activities by an entity. I have not taken their additional capital interest by the owner. That is additional money transfer, not an earning. So therefore not an income. Income, I need to divide into two. Number one is capital income. And second one, revenue income. I divide capital income and revenue income. Income is basically divided into two, capital income, revenue income. Now, capital nature income means, it is not coming always. It is not coming always. That comes very rarely. Very rarely means maybe once in 3 years time, once in 2 years time. It is not going to be recurrent nature. Now coming to expenditure also earlier I discussed. The revenue expenditure recurrent nature. Always each month, each year they are spending that money, incurring. Capital expenditure not like that. Very rarely we buy a motor vehicle, we buy machineries and all. Very rarely. So coming to income also here, when it comes to capital nature income, that is not recurrent nature. Very rarely we get it. So therefore we can say capital income what? This refers to income which is in relation non-current assets. And therefore it comes by disposing non-current assets or because of value increase in a non-current asset. You can say revaluation. So therefore capital expenditure is taken place in case of disposing non-current assets or as a result of value increasing or value increase in a non-current asset. So capital expenditure always related to capital asset. That means non-current assets. Can remember earlier. Here also actually in relation to non-current assets, you can say disposing non-current assets, value increase in non-current assets. These are the two ways of earning capital income. Always in relation to non-current assets. Remember, please. Right. In case of disposing a non-current assets, and also in case of value increase in non-current assets, you are earning capital income. So capital nature means a little bit very rarely we are getting that kind of an income, not frequently, not recurrent nature. The common revenue income that is actually happening each and every week, daily, monthly, weekly happening. That means revenue recurrent nature is there. For example, we are selling goods every day. So sales income. If you rent out your buildings, extra buildings, you get rental income every day. If you buy shares for the share market each year or annual year, semi-annual, you get the dividend income. Understand? Or in other words, if you deposit money, you get interest income. I think I told you. So remember now, recurrent nature is there. Okay, but anyhow, this revenue income, I have planned to divide into two here. Those are trading income and other income. What income? Trading income and other income. What is trading income is the income earned from the main business. The income earned from the main business is what? Trading income. My business is conducting classes, my tuition fee income. If I do buy and sell ready-made garments, my sales income. That is the main business. Any earnings for the main business can be known as trading income. So let me write down using black color pen. From main business. From main business. Other income means not from the main business. Other than the main business, if you earn some income, that is not other income. We can say from other businesses or other businesses. From other businesses. Here from main business. Let me underline main business and here other business. And the other income, you know, examples, dividend income, interest income, rental income, so on and so on, investment income, and so on. You can take under what? Other income. But main income is going to be trading income. which is from the main business. I hope you understand. Very simple. But remember this is well, otherwise you are losing marks. And a capital income that comes as a result of non-current assets by disposing of value increase. Value increase what? Well, let's say before 10 years you acquired the land at a cost of 20 million. Today, after 5 years, when you revalue, the value has gone up to, let me say, 13 million, 5 million, 13 million, 8 million value increase. You're gonna, when day by day, after a few years and months and all, value of the lands increase. Earlier you acquired at 20 million, today it's 30 million. So by 10 million, the value cost has gone up. So that 10 million is a capital income, but not like revenue. You are revaluing lands not every year. So okay, after some time, so therefore that is your capital income. So capital nature, revenue nature, please understand. That's my main objective of doing this or giving this to you. Clear? Very interesting. Okay, why don't you write this now? I gave you the first sentence and examples are given to you. And please take down this as short note. Capital income, revenue income. These are this thing. These are this thing, right? Then I will explain one by one. I believe the whole stuff that you have written down, right? No problem. It's okay. Took down. So we can take one by one. First, you can say capital income. Subtopic can say capital income. And that you can say, this refers to the income earned by disposing. Don't use word sales because there's difference between sales and disposal. I'll explain when it comes to disposal of non-current assets. Now for driving, we can say by disposing. Non-current asset by disposing or by value increasing of a non-current asset. Of non-current assets. This refers to the income earned by disposing or value increasing of non-current assets. Non-current assets. Right. And example you can say under that you can say example. A motor vehicle acquired at 30 million. A motor vehicle acquired at 30 million has been sold at or had been sold at 42 million. A motor vehicle acquired at 20 million had been sold at rupees 42 million, or any value you can add. 42 million. Another example, a land acquired before 5 years at a cost of 5 million. A land acquired before 5 years at a cost of rupees 5 million had been revalued. How to get the value? New market value, revalue. Had been revalued at 9 million. Had been revalued at 9 million. Had been revalued at 9 million. Okay, good. So there you can see capital gains are there, capital income. Coming revenue income have a subtopic, revenue income. Revenue income, and that you can say. This refers to the income. This refers to the income earned daily, weekly, monthly, annually, etc. in a recurrent manner, etc. in a recurrent manner. Recurrent means what? All the times. In a recurrent manner. Continuous manner. In a recurrent manner. Full stop. Okay. Example you can say rental income, interest income, dividend income, investment income, etc. Oh no, sales income, etc. Sales income. I forgot to give you sales income, etc. Sales income, etc. Now, subtopic we can say trade income or trading income. Trade income or trading income subtopic we can say. This refers to the income. This refers to the income. This refers to the income earned from the main business. This refers to the income earned ERNED from the main business. Earned from the main business. This refers to the income earned from the main business. Okay, their example taking down sales income. Example you can say sales income. Sales income. Then why don't you write the other topic, subtopic, other income, please? Because this wording is very much familiar, the statement of income, other income category. And other income subtopic can say other income. So this refers to the income earned from other than the main business. From other than the main business. This refers to the income earned from other than the main business. Other than the main business. Other than the main business. Example you can say rental income, investment income, dividend income, interest income, etc. You know the set now? Write down dividend, rental, interest and investment income, etc. Right. Like I say that you need to have the ability of saying like that. So that was about income and the whole stuff I have given you. That's my responsibility to say that how this income was recognized in the books of accounts by Lucas. In other words, double entry system. I am going together, right? Double entry system, this introduction, and then I am moving next week part. As I told you, accounting equation, and then to profit equation, your pet area in the syllabus. So now let me say, now usual balance of an income account is going to be credit. CR. That's what Luca Pacioli said. Then if you want to increase, you want to do the same thing credit. If you want to decrease, you want to debit. You can say DR in simple term. So this is what the theory they are, right? Double entry. Usual balance is credit. To increase credit, to decrease debit. With that we can finish. So equity I'm not going to take it again because under liability today, under inter-liability area I told you, inter-liability is nothing but the capital and equity area, which is recognized in the books of account according to business entity concept. I have clearly explained to you. We are business entity, the owner and the business, two separate parties. So there we got to know that very clearly, and then I have given in a table there, I can remember, nature of the business organization and what is going to be the inter-liability. Okay, it differs, that's why. Sole traders, this is. Partnership, this is. Incorporated company, this one. Not for profit organization, this one. So inter-liability, nature and everything I have given you. So therefore, equity is nothing but part of liabilities, which is known as internal liability. So I don't want to take separately equity as separate element. So with that, I think I have completed elements of accounting, which is very important. So the other day, I'll let you start with accounting equation, profit equations also. And before that, I hope to distribute or share a tute is with you. Right, my first tute is with you, which includes a few accounting equation sums. And then keep your past papers also ready. You can buy advanced level past papers from the market. You go to Bookshop and see a lot of past papers. I don't want the answers, but actually I want these questions. So I don't want this maximum number of past papers you buy. Don't expect whatever answers. If more papers are there, that's really good. Okay, from today onwards, backward last period, last time backward, you can go in number of years, more papers, really welcome. I have all stuff, then you better buy from there. And then I discuss my theory with my own sums, and then I can say, turn to this year, this paper, this question, this year, this paper, this question. So likewise, I take each past paper question from that past paper set, then and there I try to cover it up. Then you are happy with my stuff and also the your past paper, your examiner stuff. Then that's your examination. No? That means you make your own trust or confidence that you will be able to sit for exam without hesitation, right? These days, 23 students, examination is in progress. So therefore, you will also one day be like this, okay? This time. So with that, I don't want to waste more time. We are going to conclude the time, stop the class for the day. Thank you very much for joining. And also, I wish you all a very pleasant and happy New Year to you all. 2024, I was unable to wish you. And then hopefully we are meeting at 11 o'clock with your BS teacher. Manoj sir will take it up and take you over this business studies theory and practice. And I wish you a very pleasant day and triple gem bless you all until we meet in my next class on the same.